Credit card companies generated $130 billion in interest and fee revenue in the United States alone last year. That money does not materialize from thin air. It is extracted directly out of the checking accounts of ordinary people who went to work, earned a paycheck, and then handed a portion of it back to the bank. The system relies on marketing hooks like sign-up bonuses and travel perks to draw users in, effectively masking the underlying math of interest rates and fee structures until a balance begins to accrue. A credit card functions as a highly optimized wealth extraction machine. The question is whether you are using the machine or the machine is using you. 55% of cardholders generate 80%. Every element of the product, from the onboarding offers to the app interface, is engineered as a psychological funnel designed to migrate users from the deadbeat tier into the profitable tier. Navigating this system requires opening up the machine and studying the precise math and psychology it uses to generate that revenue. The primary engine driving the bank's revenue is a feature positioned prominently on every monthly statement: the minimum payment. A $3,000 balance at 20%, paying a 2% minimum, takes 14 years to clear, adding $3,200 in interest. The cost doubles to $6,000. Paying $150 flat clears it under 2 years, dropping interest below $400. The 2% minimum payment is a mathematical optimization. It is designed to ensure your balance reduces at the slowest rate possible, allowing the bank to collect interest for over a decade. Statements are formatted to hide this total cost, prioritizing the smallest payment option to keep the balance active. Missing a payment due date incurs a visible $35 penalty. However, that fee is merely a distraction from a much more expensive punishment hiding in the terms and conditions. A missed payment triggers a penalty APR, jumping from 19 to 29%, adding massive interest. It also hits your credit score. On a future $300,000 mortgage, that score drop means a higher rate, costing over $72,000 across 30 years. The system is aligned with these tripwires. A single lapse in focus can lock you into a higher profit tier for years. This raises a question. Why would a profit-driven bank give away free money and travel points just for using their product? Spending physical cash creates a pain of payment, a natural psychological friction. Credit cards bypass this by deferring the cost to the future, disconnecting the joy of a purchase from the reality of the expense. In MIT auction studies, participants using credit cards were willing to bid up to twice as much for the exact same items as those paying with cash. The mere presence of a card logo increased their willingness to spend. If a rewards card induces you to spend an extra $200 to earn $3 in points, you haven't gained a perk, you've subsidized the bank's margins. These rewards programs function as a psychological lever, inducing the exact overspending behavior that funds the bank's record profits. Instead of discarding credit cards, you can redirect the system's own mechanics to extract value from the bank. Legally reversing this wealth extraction requires adopting the behaviors that make a cardholder a net cost to the bank. The first step is to automate your full statement balance payment every single month. This single automated action starves the bank of its primary revenue engine. It neutralizes the minimum payment trap and ensures you never pay a cent in interest. Once interest is eliminated, you can harvest rewards by using a flat 2% cashback card for normal spending, treating it exactly like a debit card. On $2,000 of essential monthly spending, a 2% return yields $4,800 over a decade, money funded entirely by merchant fees, not your own interest. By removing the interest variable, you turn a predatory machine into a passive income stream. This strategy also provides a legal shield. Consumer protection laws make credit card companies jointly liable if a vendor fails or a product is faulty. Unlike debit cards, which expose your cash to fraudsters, credit cards act as a buffer. The bank absorbs the loss, not your bank account. Following this framework requires 5 rules. Automate full payments. Spend only what you have. Calculate fees honestly. Never take a cash advance. And never rely on willpower. Willpower is fragile. Automation is the only reliable defense against a $130 billion machine. These 5 rules provide the strategy to stop serving as a profit center for the banks, repositioning a predatory extraction machine as a tool for your own financial leverage.